Canadian taxes, a thorn in everyone's backside right now. Federal tax, provincial tax, employment insurance, Canadian pension plan. Today, I'll be explaining the basics of the Canadian tax system. This is a remake of a video from 2021. It's been pretty popular, so I'm going to remake it and I'm going to answer everyone's questions that they left in the comments. If you don't know who I am, I have a lot of experience with Canadian taxes, learning about it in university, then preparing tax returns as part of my chartered accounting designation. Before I get started, if you're a beginner or new to Canadian finance, I've created a course for you called Canadian Finance Pro. It's 8 hours long, over 60 videos where I discuss budgeting, credit, inflation, managing debt, tax, where to invest, and how to invest for beginners. This video is just a snippet of what I'll include in the course. The course is meant for beginners, so if you're looking for some advanced topics, that will come later on as I continue to add to it. And there's a new added bonus with every purchase. I'll do a 1 hour one-on-one Zoom chat with every new member. I'll start off with a little intro, non-taxable items, then break down tax brackets, then different types of income, then refundable and non-refundable credits. Canadians are taxed on their worldwide income. A lot of people get caught up in this. If you live in Canada but provide online services across the world or work for a US company, all that income must be declared on your tax return because you're a Canadian resident. If you do a 9-month secondment in another country, which is a tax-free country, you still have to declare that in Canada and pay tax on it. There are no free rides. That is income, and you are taxed on your worldwide income. If you have no income, you're not required to file taxes every year. There are no penalties, but you could be missing out on refunds and credits the government owes you. So once you're 18, just start filing taxes. Even if you have no income, you could be missing out on some money. If you have income but didn't file, there are no penalties if you're getting a refund. So you can skip, but why would you skip if the government owes you money? That's your money, just file. If you have income, didn't file, and you actually owe money, there are penalties, and the penalties are pretty high. They're charged monthly, I believe 1% per month. So make sure you file on time and pay your tax owing. The Canadian tax system is a progressive system, so the rate increases as your income increases. Taxes are broken into 5 parts. Federal taxes apply to all Canadians, then provincial or territorial taxes depending on where you live, then CPP, Canadian Pension Plan, then EI, Employment Insurance, and then Health Premium. Provinces have their own tax brackets, so your tax burden varies depending on where you live. I believe Nunavut has the lowest average tax and Quebec has the highest. Certain items aren't taxed, which is important to know. Gifts. In the US, gifts are taxed, which is lame. In Canada, you can get gifted $1 million cash and it's all yours, no tax. Inheritances, words are hard, are not taxed. Imagine getting an inheritance like stocks, but then you have to sell the stocks to pay the tax you owe on the inheritance. That's dumb, no inheritance tax. This is not to be confused with tax paid by the estate. If your grandparent passes away, there's a deemed disposition upon death, so they might owe a lot of taxes on the assets that they have, but when you inherit the after-tax cash or the after-tax assets. Lottery, gambling, or game show winnings are tax-free. In the US, they are taxed pretty heavily, actually. In Canada, it's not taxed, it's all yours. Insurance settlements and legal damages are not taxable unless the cash you received is related to lost employment income. How can I try? I'm going to try to give you an example that makes sense. If you're suing for like 2 years of lost employment income, the government also lost out on 2 years of your taxes. So if you get paid out X amount on lost employment income, the government will tax you. Lastly, income from selling a principal residence is not taxable, aka selling your house. That's tax-free, that is yours. Keep in mind, a person can only have one principal residence per year. Looking into tax brackets, this graphic pretty clearly breaks down the federal portion of income tax. These are progressive rates. Everyone will be charged 15% federally on the first $53,359 of income. Then read the bolded part. The rate on the next $53,000 is 20.5%. So it's not suddenly 20% on the first and now 20% on the second. It's 15% first, then 20.5 on the next amount. Then 26%, then 29%, then 33%. I'll run a few scenarios. If you earned $45,000 in 2023, you'll owe $6,750. If you made $90,000, you'll owe $15,515 federally. If you made $150,000, you'll owe $30,196. Keep in mind, I'm just talking about federal amounts only. You have to add in the provincial taxes. Every province has its own tax rate and bracket. Looking back at those three images I used, the province was Ontario, so you'll see the total amount owed if you're in Ontario. The most important part for the person watching this is your marginal tax rate, which means the new tax bracket you're in. Every additional dollar you get will be taxed at your current tax bracket until you get bumped into the higher bracket. If you get a raise, you shouldn't be afraid of getting bumped into a higher bracket. You will never make less money by getting a raise, but you will pay more tax. Remember, the tax system, the tax rates are progressive. The more you make, the more you owe, but you'll never have less cash by making more. I hope that made sense. Using the Wealthsimple tax calculator, take a look at the marginal tax rate as I move up the income level from $125,000 to $150,000. The marginal rate is the same. Obviously, the average rate is going up, but from every additional dollar from $125 to $150 is taxed at the same 43.41%. Take a look what happens when I bump up the income to $152,000. The new marginal rate is 44.97%. You've just been bumped into a new bracket. Every additional dollar you earn is now taxed at this higher rate. So now that we've talked about tax brackets, but take a look at the Wealthsimple graphic. There are additional amounts you're paying. Canadians also have to pay EI, employment insurance, unless you're self-employed, and CPP, Canada Pension Plan, for every province except Quebec, where they have QPP. EI is employment insurance. You can get money, let's say 9 or 10 months, if you are laid off from your job. Keep in mind, if you quit your job voluntarily, you do not get unemployment insurance. If you get a severance, your EI does not start until the severance has run its course, whether it be 2 weeks or 2 months. EI is paid by the employee and the employer, and it's a fixed amount. The amount varies and moves up every year. The rate for 2023 is 1.63%, up to a maximum of $1,002.45. If you earn $61,500, you'll pay the max amount. If you earn less than $61,500, you'll pay less than $1,000. If you earn $100,000, you'll still only pay the max $1,002. An example, sometimes this happens, if you have 2 jobs within a year and you're charged double EI, you'll get this back as a refund. When you file your tax return, you get any excess back. Every year, every Canadian can only pay a max of $1,002. CPP or QPP are the pension plans. They're paid by the employee and matched by the employer. If you're self-employed, you actually have to pay double. You have to pay the employee portion and the employer portion. This is similar to EI. It is a fixed rate up to a maximum amount per year. You cannot pay more than the maximum amount. You'll get the excess back as a refund. The rate is pretty high. The rate is 5.95% for 2023, up to a maximum of $3,754.45. If you earn $63,100 in 2023, you'll pay the max. If you earn less, obviously you'll pay less. And if you earn more, you'll still only pay the max of $3,700. Lastly, many people don't even know this exists. It's the health premium. Some provinces have it, some don't. It's just another hand in your pocket from the government. If you're in Ontario, if you make under $20,000, you pay no premium. Then it increases to $300, $600, and $900 maximum if you make over $200,000. In Quebec, I believe the max amount is around $650 in health premium. The confusing part now comes into the different types of income. The type of income you earn is taxed differently. Unfortunately, employment income, just having a regular job, is taxed the highest, as well as passive income like just earning interest. There are very few deductions and tax breaks for the common employee. Interest income is also taxed at this highest amount because it's considered passive. Self-employment income is very different. Self-employed Canadians do not pay EI, so they save 1.63%, but they have to pay double CPP or QPP. So since employees pay 5.95% and it is matched by their employer, the self-employed person must pay both. That sounds like the self-employed income, the self-employed person is worse off, but they're actually much better than employment income because of the deductions. Anything you spend to earn income can be used to reduce your taxes, unlike a regular employee. If you drive to your office as an employee, it's not deductible. That's just regular cost of commuting. But if you're self-employed and you drive to clients, you can deduct a portion of your car and gas and insurance. You can also deduct a portion of your phone, home office, or interest and even meals if you're taking clients out. Earning $100,000 employment income is great, but it might be, let's say, $73,000 after tax. $100,000 in self-employed income might be $85,000 after tax because of all the tax deductions. Capital gains are probably the best form of income. It is the lowest taxed at higher levels of income, probably above 50K, and the second lowest under 50K. And I'll just show a few examples. Capital gains are just buying an asset and selling it for a gain, buying a stock, selling it for a profit. It is 50% tax-free and 50% taxed. The wording is important. Sometimes it's misread as capital gains are taxed at 50%, which is not true. Capital gains are 50% tax-free. It goes right into your pocket. And the remaining 50 gets added to your income and then taxed at your marginal rate, which I discussed earlier in the video. If you sell a stock and you make $20,000 profit, $10,000 goes directly in your pocket. That's yours. It's not taxed. The remaining $10,000 gets added to your income and then taxed at your marginal rate. If you currently pay tax at 33%, you'll pay $3,300 in tax. That's $3,300 on a total income of 20 grand. So it's an actual tax rate of 16.5%. Looking at this chart, if we're looking at Ontario, the capital gains are exactly half of the other income section. Capital gains are the best form of income. Lastly, let's talk about dividends just very briefly. It's probably the most confusing, so I'll try to keep it basic. There are eligible and ineligible dividends. Words are hard, and they're taxed differently. I'll focus on the most common, which is eligible dividends. These are taxed very favorably. To keep this explanation short and simple for the purpose of this video, dividends are paid by companies. Companies already pay tax. So if they pay tax and then pay you a dividend and you pay tax, the income is getting double taxed, which is very unfavorable. So why would anyone want to do this? So now the CRA has added a little rule, a little tax credit. When you receive a dividend, you also get tax credits to reduce your tax payable. That's as simple as I can cut it. Just back to this Wealth Simple calculator, take a look at how favorable dividends are. The magic number is around $50,000. If we only earn $50,000 in dividends in Ontario, we will pay zero tax, zero federal, provincial, CPP, or EI. The only tax we pay is the health premium of $300, $600, or $900. These are the dividend tax credits reducing your income. Last topic, let's talk about tax credits. You know, I probably should have discussed this first before talking about the dividend credits, but that's fine. Tax credits come as refundable and non-refundable credits. Tax credits reduce your tax payable. Refundable tax credits mean they could bring your tax payable below zero, which means you get a refund or a bigger refund. You will get some cash back from the government. These aren't that common. Non-refundable tax credits are more common. They can only bring your tax payable to zero and not below. You can't get an extra tax refund or cash back from these credits. An example of a non-refundable tax credit is doing a donation. You get a slight tax benefit if you donate. If you donate during the year, you get a slip as proof, let's say a tax slip. You can use this to reduce your tax payable. However, you can't donate so much that it brings your tax payable to zero and then you get a refund on top of it. This is to stop people from making a huge donation. Let me create an example in my head. Let's say you make $10,000 a year and you magically donate an art piece that's $10 million. Then claim a $10 million tax deduction and get a huge refund. It doesn't work that way. Your donation will only count as $10,000 max. That's it for this video. I go more in depth in my course if you're interested. If the 8 hours is too long for you to watch, you can pick and choose which topics you're interested in, or you can ask all your questions during the one-on-one chat offered as part of the purchase. I try not to go into too much detail since it'll be too confusing. I feel like this video is long enough as it is, and now I'm stumbling over my words. Last week I discussed spousal RSP, this week beginner taxes. Let me know of any other tax topics you're interested in. A few months ago, I spoke about self-employed taxes, then salary versus dividends in terms of paying yourself if you're self-employed. One last thing I'll comment on is no, I will not do your taxes. Thanks for watching and tune in to the next one.